Welcome to the third virtual education luncheon for 2022, the case for structural evolution in private equity. My name is Kyle Brody, and I am a member of the programming committee at CFA Society Winnipeg. CFA Society Winnipeg has now served the Winnipeg investment community for 70 years by promoting ethical and professional standards within the investment industry. Our society is an active participant and innovator within our international organization, the CFA Institute. We're also a member of the CFA Societies Canada, which promotes advocacy efforts to our federal and provincial regulators. In addition, CFA Society Winnipeg provides our members with professional development and educational opportunities, job placement services and membership, and networking events. Today's discussion focuses on private equity and particularly the structural evolution currently underway within the sector. Andre Bourbonnais and Ash Jaidev will be joining us from BlackRock to explore the current state of private equity markets and investment activity, the benefits of flexible active ownership, and live underwriting examples, particularly through and following the COVID-19 environment. Before turning things over to Mr. Bourbonnais and Mr. Jaidev, I'd like to take this opportunity to provide you with a brief introduction to our guest speakers. Mr. Andre Bourbonnais is a managing director and the global head of BlackRock Long-Term Private Capital. Andre brings over 30 years of private market transaction and management experience. Andre was most recently CEO and CIO of PSP Investments, the $110 billion Montreal-based Canadian public pension fund, where he led all investment functions and presided over a rebuild of the firm's private market capabilities. Andre previously served as Senior Managing Director and Global Head of Private Investments at the Canadian Pension Plan Investment Board, where he was responsible for over $65 billion in private market assets, the largest program of its kind globally. Over a nearly 10-year career at CPPIB, Andre built the firm's pioneering direct investing capabilities into one of the most respected in the world, while growing the private markets investment team from fewer than 20 to over 230 professionals. Prior to CPPIB, Andre was a senior investor at Caisse de dépôt et placement du Québec, serving as president of financial services and president of CDP Capital Communications, Inc. Over his career, Andre has overseen over 50 private market transactions across a range of sectors, including financial services, healthcare, telecommunications and technology, industrials, entertainment and media, and infrastructure. Andre received his master's degree in law from the London School of Economics and his bachelor's degree in law from the University of Ottawa. Our other speaker today is Ash Jaidev. Ash is a director and member of BlackRock Alternative Specialists. He is responsible for driving private markets strategy and development in the Americas. This includes initiatives across private equity, credit, infrastructure, and real estate through funds and direct co-investments. Previously, Ash was responsible for strategy and business development focused in private equity, including buyout, secondaries, growth, and co-investment strategies. Ash moved to his current role from BlackRock's global retail business. Previously, he was a founding member of the Global Platinum Client Program, supporting the management and coordination of the firm's strategic global wealth distribution relationships across product channels. Ash joined BlackRock in 2012 as part of the global retail and iShares strategy team, focusing on cross-functional initiatives across the wealth channels. Ash earned a BA degree in economics and history at Northwestern University. As we prepare to be enlightened by our guest speakers today, please note, if you have any questions throughout the session, please send them via the chat bar in the bottom right corner directly to Ash Jaidev. At this time, I would like to pass things over to our honored guests, Andre and Ash.
Perfect. Excellent. Kyle, thank you so much for the introduction, and it's great to see so many boxes on the screen here. Thank you all for joining Andre and I today in what we call a fireside chat. We're obviously virtual here, Andre, and it's quite warm as it is outside, so maybe no fireside needed, but we'll try to make this and keep this as interactive as we possibly can over the next hour or so. It's always humbling, I think, to me to listen to my biography read out loud right after Andre's. Of course, the feature of today's discussion is really Andre, given his 30+ years of experience in private equity, an asset class that, of course, has grown incredibly meaningfully over the course of that 30+ years, but in some ways has failed in some ways to evolve structurally to meet the needs of both management teams and companies that oftentimes are seeking more long-term and more aligned capital. And then equally, in many ways, that misalignment between the GPs in private equity, the general partners and sponsors, and the LPs, the investors who are seeking access to these companies through the traditional private equity fund model. So, we titled this session, The Case for Structural Evolution in Private Equity. It's a big topic. We could spend hours talking about structural evolution and the history of the industry and the asset class. But I think hopefully what we want all of you to take away is, in some sense, maybe three main areas of focus or themes. The first being really what has worked and what hasn't equally in private equity over the last 30+ years. The second topic being how structure is intrinsically linked to investment strategy and therefore intrinsically linked to performance as well. And in many ways, structure within the private equity fund universe goes relatively unappreciated, and we'll tackle a little bit around how we've thought about the evolution in structure. And then finally, why a flexible approach drives better alignment, and that alignment is measured by both, again, our alignment with our companies as well as our alignment with our investors. So to do all of that, of course, we have Andre Bourbonnais on the line. I want to start, Andre, with your career history a little bit, and we'll get thereafter into what brought you to BlackRock, what you've been building over the last 4 odd years at the firm. But Andre, maybe I'll pause here and turn it to you. I like to start very simply with how did you get started in this business? Of course, private equity has been so fundamental throughout your 30-year career, but walk us through, for the audience as well, a little bit around your path through a lot of the Canadian institutional investment landscape, and then and your journey through private equity as well.
Sure. And first, thanks, Ash, and thanks to the CFA Society. It's, I think, my third presentation here, so I'm becoming sort of a fixture, but every time I enjoy talking about this. And hearing my bio just reminds me, how old I'm getting, so you don't have anything to be humble about. Listen, first, I don't think I would recommend to anyone who wants to get into private equity to follow my path. I think that mine has been a little bit different, and the environment has changed significantly. So, but I was trained as an economist and a lawyer, and started my career in private practice for one of the large firm in Canada, Stikeman Elliott, and hated every minute of it, quite frankly. So, but what I really liked was understanding what my clients were doing. I was doing corporate M&A and securities, so understanding how they were managing their businesses, how they were making money. So I was spending quite a bit of time trying to understand that before writing the pages and pages of documentation that I did. But first opportunity I had to move out of it, I did. and then started to work in M&A consulting. I had an opportunity after spending a year in London to go back to Europe, so did that. And then after a few years doing that, one of my former client did the putsch in the telecom industry, bought a company, and as he said, he didn't try to find who was good and who wasn't. He fired everybody and brought his own team and called me up and said, would you be interested in coming back? And I did a mix of law and corporate development, but really more focus on corporate development there. So that's really how I started my career as a principal, doing acquisition. And then we sold a company to BCE. And my former CFO became the head of private equity at CDPQ, and called me one day and he said, listen, I have no friends here. I need somebody I can trust. Would you come and work with me? And I didn't know anything about private equity. I knew even less about financial services, but sometimes you need people in your career that will believe in yourself, believe in you more than you believe in yourself. So I took the plunge and really fell in love with that aspect of finance. And what I really liked is the fact that we were able to make decisions, but we had to live with that, as a consultant, either as a lawyer or when I did M&A consulting, you kind of, do your work until the closing dinner. And after that, you're sort of, but when you have to sign at the bottom of the page, live with your decision and look at the performance of the company you bought every day. I find it terrifying at first, but also quite exciting and motivating. So did that for a number of years, and then I had an opportunity to move at CPP, and believe me, in 2006, CPP was not the CPP that we know now. We had $3 billion of assets under management and private investment, mostly private equity funds, a little bit of infrastructure. And I participated in that fantastic journey of growing it. And now, I can't fathom what John Graham is going through, because it's become so big, like more than $500 billion in assets under management. But after a number of years, I had a very young CEO who was about 8 years younger than me, and had bigger aspirations. So, and when the recruiter called for the job at PSP, first it was back in Montreal, which I liked, but also, when you've decided pretty young in your career to become a manager, being the ultimate manager of a business is really exciting, and the same way, I like making decision on investment and be accountable for them. Making decision for an entire business and being accountable for those decisions was really appealing to me as well.
Yeah, thanks, Andre. I think what's interesting to me when I hear your experiences and your background is it's been quite diverse. It's not just private equity in the most traditional sense. So to your earlier point, you've been a business builder, you've been a manager of teams, and we should talk maybe at some point later in the conversation around how you build these high-performing teams to actually invest in the way that makes good sense. You've obviously been a lawyer in the past, whether you like it or not, and you've taken all of that experience, Andre. You brought it to BlackRock. We're coming up on your 4-year anniversary at the firm, in fact, and I'd be curious, before we get a little bit into your observations of the market, just talk to us a little bit about your motivations for joining the firm. You've been on the client side for almost all your career. You decided to join a manager at this stage in your career. So just talk to us about why that was.
Yeah. So, you said it, whether at CDPQ, when I literally built the financial services business and restructured the TMT business, and at CPP and at PSP, I like to build stuff. And in the fall of 17, was approached by Mark Wiseman, my former boss at CPP, and Larry, who I knew well because we were big clients of BlackRock, who told me, they said, listen, we have this idea of doing private equity differently. We don't want to start the so-called traditional 2 and 20 fund. we think you're the guy to run it. Would you be interested? And, you know, at first I'd say, listen, I run a $150 billion pension plan, and you know, you're offering me to become one of 1,600 MDs at BlackRock. You know, tell me more about this idea. And really what convinced me is that it was a pretty unique opportunity to build something, but really from scratch, something that was strategic to the firm, who's the largest asset manager in the world, but also something that I felt could not revolutionize, but definitely create some evolution and change a little bit the traditional private equity landscape, and do it from a blank piece of paper with no legacy business to protect, no conflict within the firm because all the direct buyout deals would go to this fund. So, you know, at the end, I was convinced that if I had one more thing left in me in my career, that was a fairly unique opportunity to do this, and that's why I sort of took the plunge in it.
Yeah. Well, thanks, Andre. I want to switch a little bit now to talk about the market in private equity and maybe specifically around structures. And of course, private equity has a 35, 40-year history. Let's not tackle all of that. Let's focus maybe on the more recent history, right? Especially in maybe the last 5 or 10 years. I think we've seen so much growth in the asset class and some change in the asset class as well. And in the spirit of talking about structure, maybe paint for us a picture around what you've seen in structural evolution in private equity dating back to your days as an LP at PSP and CPP, and what you're seeing now. And of course, COVID was so much a part of the last couple of years. We should get to that as well. But just first, maybe paint a sense of that, you know, those observations of the last five or so years.
So a few years ago, when I was making presentations on private equity, I used to joke, and I'm going to make a cultural reference that none of the CFA in this cohort probably understand, but in the US, there's this show that has been going on for, I don't know, 40 years called The Young and the Restless. And I used to joke that if you fell asleep in the 80s and just woke up and watched The Young and the Restless, it would take you like 2 or 3 episodes, and you know, it's the same character, the same plot. Nothing has changed really, and it's a little bit the story of private equity, because the private equity, you know, has become more sophisticated as it evolved. But the model and private equity over the years, for some firm, not all the firms, for some firm have relied on a more operating model versus more financial model, but some firms continue to do really well just based on financial structuring and engineering. So the model had not really evolved. And what I was finding, quite frankly, is that it has changed, but a little bit to the detriment of the LPs. And you know, I was a big LP at the case at CDPQ, at CPP and PSP, so I could see it. And you know, in the 90s, in the early 2000, when I started my career, you would see a private equity fund come to you. You would make a commitment. Those days, like $200 million, $300 million was like a huge commitment. And then you would see them like 5-6 years later, and they would show you the progress of their fund, and then they would start again. So if you look at all the household names, it took them a long time to ramp up to the big numbers that they're raising right now. Now, however, the process has been completely truncated, and it's not uncommon to see those funds coming back to the market 18 months after launching a fund. So this view that private equity is for the long term has really shifted, and in a way that you know, is relatively, especially in the last 10 years where the market was only going one way. But all the terms and conditions that we fought really hard as LP to get, you know, hurdle rate and meaningful key man clauses and fee offset, all of those largely were like disappearing slowly. The fact that the funds were coming back to the market so early was an incentive for them to sell a very good company early in the process, because they wanted to show those winners to raise another fund, to crystallize carry, whatever the reason was. So what we could see was that at a time where the funds were getting much bigger, there was no movement on fees, so the fees were not, going back to more reasonable numbers, and the long-term view that was originally the intent in private equity, that was getting shorter and shorter. So certainly, both at CPP and PSP, I felt that there was a space for longer-term investors, people that would hold on to companies for a longer period of time, which probably wouldn't impact IRR that much, but would have a significant positive impact on the multiple of capital because of the compounding of the value of the company that you would hold for longer.
Yeah, so Andre, there's a lot in there, and I want to now sort of take a lot of those concepts you just described and now apply to your rationale for joining BlackRock. So bridging your last couple of answers, it seems that you've obviously over the last 4 years joined BlackRock. You called it a sort of a blank sheet of paper to build something maybe very much addressing or in response to some of those constraints in the market that you just described. So let's maybe hit the nail on the head. What is it that you think you've done maybe differently or are trying to do differently at BlackRock relative to the market and relative to all that, structural sort of constraints and opportunities that you've observed?
Well, like I said, I had no intention of joining to create another, traditional 2 and 20 fund. I don't think the world needs another one. And when we look at the deficiency of traditional private equity, and again, I'm not doing, first of all, we have a very big traditional private equity practice at BlackRock. I'm still a firm believer that there is room for different type of funds in the private equity world. And certainly what we were trying to do was not to be everything to everyone. We were really trying to address what we saw as a gap in the traditional private equity offering. So that gap was really to address a couple of things. First, the longevity of how you hold these companies. I had been in most of the funds, so I saw very, very good companies being sold from KKR to Blackstone to CVC to back to TPG. So companies that were in the private domain for 14, 15, 16, 17 years with huge fee leakage, because every time those funds would sell, they would clip their 20% carried interest. So from a multiple of capital point of view, even if you were in each of those funds, you would get, assuming that we meet the base case in all of those investments, you would have decent, let's call it, 15% net IRR, but your multiple of capital would be impacted because you can never reinvest the full amount. So one of the things I wanted to address was the compounding of very good companies, and in order to do that, you needed permanent capital or very, very long-term capital. So we've decided to go the permanent capital route, and that really allows us to make decision on whether to keep or sell a company based on the idiosyncrasies of the company and not on some exogenous factor. So that was the number one. The number two, which obviously is influenced by me having been on the institutional side and client side for 20 or so some odd years, is the fact that as the fund grew bigger, the fees were always a percentage of the asset under management. And while at the beginning they served really to keep the lights open and pay people so that they can pay their grocery mortgage, that percentage, didn't decline as much. It went maybe from 2 to now, let's call it on average 1.6, 1.7%. But on funds that are now, $20 billion instead of being $5 billion. So it's creating some conflicts of interest. I think in the way that we saw it, we said, okay, let's figure out how much it's going to cost to run the business, and that's what we're going to charge to our LPs. And we're going to make money on the carry the old-fashioned way. And if our clients are successful, we'll be successful with them. The idea of lower fee was not really to be sort of the Walmart of private equity, but it was to allow efficiency in the fund to be able to underwrite transaction in a less risky, less volatile, higher conviction way, and leave tons of upside for our LPs. And if you look at the performance of our fund right now, where after 36 months we've got 2 times our money and 46% IRR, I think we've delivered exactly on that promise. So economic efficiency in the fund to underwrite differently, permanent capital to allow you to compound as long as you think that you're going to deliver those results. So those were sort of the 2 anchor that we decided to put in place structurally for the fund, and then came the strategy, like what do you do with the money in that structure?
Yeah, so let's get to that, Andre, because I think, and you alluded to this in the onset of your response as well just now around the balance maybe between sort of traditional private equity, which has existed for so long, versus sort of this newer structurally evolved model that maybe focuses more on the long term. So let's talk a little bit about the type of company that might be attracted to your capital, and maybe as a way of showing that perhaps it's not every company in the world that would be attracted necessarily to your capital, that there is still obviously room for traditional private equity, but your approach to a certain type of company might look and feel just different. So maybe we can get into what that approach is and the type of company that you would really choose to pursue.
Yeah. So when you go to CDPQ or ADIA or Minnesota or Carlsters, who are all significant investors in the fund, they have, I don't know, 70 managers, 150 funds. So the first thing they will ask you is, what differentiated deal flow are you going to bring me? Because, I don't want to revert back to the mean. If you're going to bring me the same kind of deal that CVC, Blackstone, or KKR, I'm in all those funds. I don't need to see them. So really what we needed to figure out is an approach that would do 2 things, that would allow us to address companies that would not traditionally have thought that a financial buyer was a normal exit for them or a normal partnership for them. So expand the pool of companies that can be bought in private equity. And second, in this pool of private equity, go to people and offer them a different solution. And as you said, Ash, it's not for everyone. If somebody wants to maximize the value of their company and want to hire Goldman Sachs to run a process with 15 first-round bidder and the max price, we're not going to be, and we haven't been very successful historically in that process. But if somebody is interested to have a longer-term partner, not to get into this treadmill of private equity where you have aggressive assumption, high leverage, and probably within the next 4 years be ready to sell the company and find another partner. If you want somebody who's going to focus on the 2 or 3 levers of growth and can bring value add to what you're doing without running the company for you, I think we were offering a different alternative here. So that's really how we differentiated ourselves. So what we were looking for are high quality company. So no startup, no unicorn, none of this. Company that had been around for a very long period of time, that had shown high quality, that were leader in their markets. Could have been a very niche market, but leader in their market. Between Cole Manigan, my partner, and I, we invested in, 1,000 funds. We had all the operating data, and we could see that what was successful in private equity was growth. Now, there's a lot of ways to make money, again, in private equity. You can be, very operationally driven, like CD&R, sort of turnaround artist, like Apollo is. But we felt that what we wanted to find were companies that were really focused on growth, both internally and externally. Asset light, ROIC. So the way that management allocates capital is a big predicator of future performance. So companies that had strong ROIC were important to us. So that's what we were looking, and we found companies that not only we were pushing our capital as differentiated, but they wanted our capital and they wanted our expertise. They wanted the firm's expertise and the brand name. So again, we're not a high volume business. We do 2-3 deals a year. So we don't need to boil the ocean, but in all 5 transactions and same in the pipeline that we're at right now, we got those deals not because we paid the highest price, but because we were bringing something different to the table.
Yeah, no, Andre, makes sense. And I want to get into a little bit around how you're approaching deals, especially in today's environment, how you've done it in the last 2.5 years or so as we've lived through a lockdown. But I want to go back just a little bit. We talked about, of course, taking a longer term approach, the structural evolution that's existed. I think it's safe to say that your strategy, your approach in long-termism isn't the only one out there in the market. I think increasingly in what we've seen over the last few years is more and more GPs and frankly, portfolio companies and management teams themselves finding creative ways to extend their term in their lives. Can you just maybe reflect a little bit around what's happened in the market more generally over the last 3-4 years in the spirit of sort of quote unquote long-termism, and differentiate for the audience a little bit here among some of those pools of capital?
So when I said earlier that when I was giving presentation way back, I said there was not much evolution. I think that's one area where actually private equity picked up probably in the 2015-ish space, where we could see that they were coming with an offering of longer term hold. I think there was a bit of an identity crisis at that time, in the sense that they were really sending the idea that there's company that you can hold for longer, which means lower risk but lower return. I never believed that, and I don't think that that's what they did. Quite frankly, I did one investment in that space. It's my friend Lauren Somerville at CVC. I think he's running a great fund, but again, if you look at his performance, it's not lower risk, lower return. It's essentially an extended traditional private equity fund where they still use high leverage. They still do dividend recap to send money back to their investors. So it's just doing traditional private equity, but benefiting from the money and recycling it for a longer period of time, which is fine. But what we've seen, and you alluded to it, Ash, is what we've seen recently is that people realize that they have very, very good companies. They don't want to sell them. And there has been an explosion of those so-called continuation or extension funds, where they take their best asset, get it out of the traditional fund, and put it in a separate fund with, and that has all sorts of valuation issues, but continue to carry that investment, either a single asset or a collection of assets. Mostly now it's single assets. They extend the life of holding that asset, still with high fees and lower fees than the traditional fund, but still pretty high fees. And then there's a conflict because you don't necessarily have the same investor in the main fund, and then this extension fund, you have people with a different economic deal. You have people that coming in at a different price. So to me, having the same company in the same fund, holding it there with the same investor under the same fee base is a better proposition than those. But it's been very popular. It's been used extensively. I think there's a bit of the market is regurgitating, throwing up a little bit now on specifically on single asset. It's one way of extending. It sort of flatters us in the sense that I think we've seen this trend and organized ourselves differently to do it. But if you want to hold asset for longer, now the LPs have a lot more option than they did 5, 6, 7 years ago.
Yeah, absolutely. So, Andre, we've addressed a lot related to structure. I'd love to talk now a little bit more in the nitty-gritty around deals and sort of our underwriting approach, and especially in today's environment. And folks in the line, some of you have submitted questions via the chat. Please, continue to do so, and I'll try and make sure we address as many as we can over the next, several minutes here. But Andre, I want to talk a little bit about the pandemic, 2.5 years of effectively a lockdown in many ways, and private equity somehow, minus maybe a little blip that existed in 2020, kind of just soldiered on in many ways and ballooned up into an incredibly sort of high valuation type proposition with a lot of capital, it felt, chasing a lot of, and maybe a growing number of private companies. And so the need to sort of differentiate yourselves among all of those became ultra important. Can you just talk about your experience over the last 2.5 years? Obviously, this was a unique circumstance in the world of private equity. You were able to deploy some capital during that. How did your approach to underwriting change, evolve, especially even in things like, you weren't able to maybe physically fly to meet a management team? How do you underwrite a deal when you can't actually meet the company and things like that? So I'd be curious to hear your thoughts there.
Yeah, it wasn't easy. In my 30+ year career, I've never seen anything like that. So before March 2020, we had committed to two transactions in the consumer goods space. So when the pandemic hit and the world essentially stopped and closed, shut down, I can tell you it was a little bit hot under the collar, but I think that it proved to us that the thesis that we underwritten in those two transactions were the right one. And then with the pandemic, there's a bit of a slowdown. Everybody took a deep breath, but something incredible happened where now everybody felt that they needed to get money out, and it's not because it's not because there were like great deals out there. And in the space that there were great deals, we were very well positioned through our investee to our portfolio company. So we sort of let them do that. But technology, exploded, and then the 30 was the new 20. All of a sudden the multiple just completely went crazy. But not only that, sometime, usually you have, a few weeks, you'll sign an NDA, you'll get a confidential information memorandum, process letter, first round bid, then they'll select a few people, and then you'll go in second round. Those processes were completely truncated. And if you didn't get to the first round with high conviction and the price that you were willing to do, and that's if somebody had not preempted the whole process before, you had no chance. So we we didn't stay on the sideline. We tried to look at that, but got completely blown out of the water on a couple of like fund administration deal, on ESG consultant, which was a big thesis for us. So sorry for the background noise. I don't know how to turn off that notification.
You're good.
So we looked at a number of deals, and we did two. We did two software transaction. We liked the recurring revenue, the asset light, the cash flow, but it was tough. Like, we bought a company in Manchester that has a software in the pension plan world, which we know well. All of their clients were sort of BlackRock clients on the asset management side. So we could due diligence it, but we never went to Manchester. We never met the management team in person. They told us they had an office. They did, but we never went to check it out. So it was a very, very different period of time where, you sort of, in the two deals that we did, we kind of compensated by, like I said, we were the right buyer. We didn't pay the full price. Somebody was in both that deal called Awood and another transaction in the US called TDS, Transaction Data System. We were not the highest bidder, but the seller had decided to accommodate us because they thought we were the right buyer for the business. But it's tough. And if I look at the whole portfolio, those two deals are the one that are unplanned, but they're not outperforming, while the other three deals that we did in more normal circumstances are outperforming our base case and by a mile. So maybe it's anecdotal, maybe it has nothing to do with the COVID, but I certainly will do some postmortem and try to see if that had an impact. So yeah, and for the rest, like I said, we continue to do few transactions. We have base case that involve less leverage, less aggressive operational assumption. So lots of flexibility in our base case. And if the company just continues to perform the way it was performing before we bought it, there's going to be significant upside for our investor, as we've seen in ABG, Authentic Brand Group, and Creed, which are the first two transactions that we did, where we now are like 3 times our money in ABG and almost 4 times in Creed.
Yeah, and Andre, as part of underwriting, you mentioned it towards the end there around leverage, right? Leverage as a concept has dominated the industry for its existence, and it feels as if as more and more deals get done, that reliance on leverage to generate return is as paramount as ever. We're living in an interesting sort of rate environment at the moment, but barring that, I'd be curious to hear just your approach to leverage. Well, we talk a little bit about being prudent with leverage. What does that really mean, and what have you maybe seen in terms of high leverage going sort of the wrong way, perhaps to the detriment of the business or even the investors?
Yeah, even when I was doing more, let's call it traditional private equity, I've always admired a company that had a different approach to leverage. And one of my big model was a company just down the street here called CGI. CGI is this fantastic computer technology consulting company, and they've had always like moderate leverage, but when they saw an opportunity, they were not shy to increase the leverage to benefit from it, fully integrate the business, and then delever as the synergies would come in. And I've always thought it was a real good model. So we think that we're trying to adapt that model to the companies that we're buying. And the first company we bought, ABG, is exactly that model. So ABG, we bought it, was doing about $300 million of EBITDA. For those who don't know the company, it's a company that buys brand or makes deal with individual in the sport and lifestyle so that they get royalty essentially on their intellectual property. So we bought a company about 300 million of EBITDA, and it was owned by Leonard Green. Fantastic fund, great people at Leonard Green. John Donegal has been a friend for many years, but they were getting at the end of their 12 years, so 10-year plus 2 years extension, and they needed to get some liquidity. So we came in and offered to Jamie, who both Colm and I knew from before, but mostly my partner Colm Lanigan. We offered Jamie Salter, the founder of the company, something different, and we said, but we're not going to lever you up to 6 times. We're going to take you to about 3 times, maybe 4 at the beginning, but and then if you see huge opportunities in the market, then we can lever up and then benefit from the synergies. And if you look at what we've done with ABG, so and first of all, Jamie was ecstatic. He says, finally, I can see my balance sheet as an asset and not as a liability. Second, we did the transaction, and then the carnage in retail happened. So because we were in such a good position financially, we were able to buy brands that otherwise would not have been available. But successively, we bought Sport Illustrated, Forever 21, Brooks Brothers, Barney's, and I always forget the 5th one. So Eddie Bauer. So we've done all this out of the balance sheet, and then we still had a pretty good position just given the cash flow. And then Reebok came along, and Reebok had been bought by Adidas 6-7 years ago. They were never able to do what they wanted to. Then they paid 4 billion euros, I think, for it. And we came in and we paid 1.2. By the time we closed the transaction, we had licensed the brand to the tune of about $400 million a year in royalties to various distributors. And we had the balance sheet where we could borrow and still be below 5 times. So that's the approach. And with the synergy that Reebok is going to bring to the business, clearly, we're going to go back to below 4 times within the next 18 to 24 months. So that's really how we're thinking about leverage. It's like, yes, you need it. Creed, which is a high-end fragrance company that we bought, is now below 2 times. And I told people, listen, I don't like leverage, but it's not that, we can't use it. So we need to make the capital structure at least a little bit efficient. So we'll probably borrow a little bit there, but it needs to, as Jamie said, it needs to be an asset, not a liability.
Yeah, and I'm glad, Andre, we talked about leverage because, again, in the theme or topic of structural evolution, this is one, right? We talk about long-termism and the value of permanent capital, but equally the value of being prudent in your use of leverage, or at least flexible, to be able to dial up or down dependent on what's presented in front of the balance sheet. I think is pretty important. You've highlighted that. And I think, the ABG example, our first investment in long-term private capital, applies that prudent leverage mindset, as well as the fact that you bought the deal and company from a seller who really needed liquidity, but really based on a structural requirement to sell a business. I think, I don't want to put words in Leonard Green's mouth, but if they were here, they might say we would have loved to continue to own the business in the position that we were in for much longer if we had the fund structure to be able to do it.
They will clearly say that. And we don't need to go back to the early 80s with, 17% interest rate, because I don't think we're going to get there. But clearly we're, and the central banks have primed the market for interest rate hikes. I don't know to what extent they will follow up and how much, but still, we're not going to be in this low interest rate environment, extra low. We're still, relatively speaking, in a low interest. But when you increase your borrowing costs by 3, 4, 5, 600 basis points, it's starting to hurt. And then you hit a recession where, you know, your growth plan is not going to be exactly the cash flow. And then all of a sudden you're not worrying about managing the business, you're worrying about managing your balance sheet. And we never want to be in that position. And I'm not saying we'll never be in that position, but for us, you know, we make all the decision, the financial engineering decision based on the fact that we want the balance sheet to be an asset. We want to be able to benefit from opportunities that would not otherwise be available when the market tanks. And we don't want to be in defensive mode. We want to be in unoffensive.
Yep. So, Andre, we've got a few minutes left to the top of the hour, and I'm sure folks will peel off. Hopefully, a few more questions come from the audience before we wrap here. But maybe a couple more from me. The first, and hopefully this is a fun one, is you've obviously you've done a lot of deals over the course of your career, and we don't need to put the numbers again on how long your career's been, Andre, but it's been sufficiently long to have seen so much.
I think Kyle said 50. I think there was missing a zero at the end of that one. It's probably more like 500.
So of the several hundred deals that you've seen and done and led, most memorable ones, you can pick one, you can pick a few, and maybe what makes them memorable to you.
Well, I won't pick and choose, so I'll give you the good and the bad. I think one of the most memorable one was a deal we did alongside with Silver Lake when I was at CPP, when we bought Skype, a video service from eBay. And it had nothing to do with eBay. I don't know what they had bought it in the first place, but you know, what was interesting is that the founder of Skype were also the founder, and some of you may remember Kazan, which was a audio streaming service where you can essentially download pretty much illegally songs, and they were like two crazy Estonian or Moldovan cousin or whatever, and so they were suing the company for patent infringement, and it was a very complicated situation. But we had really mapped out, you know, we said we're going to buy it for cheap. We're going to find a workaround. So if the crazy cousin are successful, we will have a way to get around the patent and continue the service. But let's probably project that it's going to cost us $100 or $150 million to keep them happy. And in the same time, you know, we will have created a lot of value in the company, settled the lawsuit, and we'll sell this thing to Microsoft. And we already had identified Microsoft as the buyer for this thing for at least 3 times our money. I could have retired after that deal because it played out exactly the way we had planned it. In that deal, there was also some interesting turn and twist. We had brought in Enderstein Orovich because they had some expertise, and another firm which will remain nameless, and which was also a small technology fund. But in the course of the discovery of the litigation, they had to give us all of their emails. In some of their emails, they were saying, "Oh, I'm so sad that we have to partner with those stupid guys at Silver Lake, and that crazy money, that stupid money of the pension plan at CPP." So needless to say that we found a way to get them out of the deal. And we did the deal. We made 4.3 times our money in 18 months, and it was a great transaction. On the flip side, you know, I had made a lot of money in MGM when I was at CDPQ on a thesis that you know, the value of the library was going to support the film industry and the film, and in that period, the film that they developed and made a lot of money, so everybody was happy. So I thought I would put the same thesis at work in a a music company called EMI that was bought by Terra Firma. Unfortunately, that holy grail of digital and people buying more music more profitably didn't materialize. We paid too much. There was fraud in the company, and unfortunately, we lost all of our investment. But lesson learned is one, buying a public company in the UK under the code is very difficult because you don't really do much due diligence. Buying a public company when there's fraud, there's not a lot of people you can sue because the public shareholders are gone. And second, the last thing, which is probably the most valuable, it's not because you made money under one scenario that the history is going to repeat itself. Each deal is very different.
Andre, if you had just described those deals without describing whether they're your best or your worst, I would have got them flipped, I think. Just the way in which you described this Sky transaction sounds interesting, but of course became your best one. Last question, and I hope I'm not ending on a grim note here, but so much going on in the world right now, Andre, geopolitics, market volatility in the public markets, which of course private equity is not immune to, inflation, interest rates, so on and so forth. What's your view as you approach the market today as a private equity investor? What are you maybe most concerned about? Where do you think there are risks that people aren't fully appreciating, or maybe risks that people are overinflating? No pun intended there. But any final thoughts from you on just sort of the market today?
Yeah, listen, it's a long time since I've never really been an economist, even I was sort of trained as one, but and there are people, extraordinary people within BlackRock, including my colleague, my French-Canadian colleague, Jean Boivin, who can give you a much better appreciation of the impact. But I do feel, first of all, we're lucky in our portfolio. We're pretty immune from Russia, and Reebok has a little bit of exposure, but not much. I think I'm more worried about the impact, the macro impact that these will have on trade. So I think that the globalization, as we've known it for the past 20, 25 years, is going to leave room for more trading corridors, if you want, alliances. The big question mark is, where is China going to stand in all this? And we have big expectation in China for our brands, and we've just started to distribute our perfume there, and relatively successfully until the lockdown. But that is a big question mark for us. I think that the recession is probably in the cards. So everything that we're looking at right now, we have a big recession case to make sure that the downside is protected. Sorry, but at the same time, you can't be paralyzed by it, and you need to look at a number of opportunities and trust your investment judgment, and just analyze the risk and mitigate them. And there's going to be great opportunities, and there's great opportunities in any market. So we just need to find them.
Absolutely. Well, Andre, always a
the one thing. Yeah, the one thing I'm really is food and food supply, and whether it's climate or the war affecting the fertilizer and yield, and that is something is actually pretty worrisome. So that's it.
Well, look, on that note, thank you all for joining us. Hopefully this was helpful in chatting a little bit about private equity. Andre, always great to talk to you about structural evolution. I see Kyle on the screen now as well. So Kyle, maybe with that, I'll turn it back to you.
Yeah, great. I guess as our time is drawing to a close, we'll have to wind things up. So thank you, Andre and Ash, for joining us today and for sharing with us your interesting discussions on private equity and the evolving ownership structures becoming more common in the sector. It's great hearing from your team at BlackRock. We look forward to it with anticipation, the opportunity to have you join us again soon. As an expression of our appreciation for your presentation today, the CFA Society Winnipeg will be making a donation in your names to Youth Employment Services Manitoba, otherwise known as Yes Manitoba, a local nonprofit organization dedicated to helping youth enhance their skills and retain employment. Thank you as well, as always, to Eva Swan for helping to set up this event. A special thank you is also extended to each of you for taking time to join us virtually today. Also, please note the CFA Society Winnipeg has a lot of great programming coming for 2022, so hopefully you can attend future events with us. The next event is the CFA Society Winnipeg's 29th annual golf tournament to be held on June 16th. CFA Society Winnipeg is also partnering with CFA Society Vancouver to bring you an event on June 23rd with keynote speaker Bruce Sellery. Bruce is currently the CEO at Credit Canada Solutions, and you'll probably recognize him from his time working as a business journalist at CTV and CBC News, or as the MC at past CFA Society Winnipeg forecast dinners. There's plenty more to come in the latter half of the year, so expect to hear from us again soon. In the meantime, take care, best wishes, and have a great week.
Thank you, everyone.